Welcome! In this video, can XCN start a rally with 580% increase? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
Measuring the price from the bottom level to the top level using the Fibonacci retracement tool is a frequently used method in technical analysis that helps investors understand market trends. In this case, the situation we are referring to is measuring the upward move from a defined bottom point to the highest peak and determining that the price is located at the 0.618 and 0.786 Fibonacci levels. These levels are generally considered strong support or reversal zones during market correction phases. This is because investor psychology and algorithmic trading systems take these levels as important reference points. In particular, the 0.618 level, also known as the golden ratio, indicates that after a retracement of this magnitude, the price may show a strong tendency to recover. The 0.786 level represents a critical threshold for sharp upward reversals that can occur after deeper corrections. The fact that the price is currently between or near these two important Fibonacci levels technically increases the likelihood of an upward reaction. These areas have historically been zones where prices paused and regained strength. A large portion of market participants place buy orders around these levels because they offer long-term, high-potential profit opportunities. At the 0.618 level, medium-term buyers often step in, while drops toward the 0.786 level attract more patient investors with higher risk tolerance. For this reason, price reversals from these regions are expected, as the accumulation of buy orders here provides liquidity to the market and pushes the price upward. Investor psychology plays a very important role in these kinds of reversals. After a rise from bottom to top, many investors take profits during the correction phase. This selling pressure pushes the price down. However, as the price approaches certain psychological support levels, namely the Fibonacci ratios, investors who previously missed the move begin to enter the market. The idea that it might make sense to buy from here increases demand, balancing out the selling pressure until buyers eventually dominate. At this point, it is common for the price to turn upward. The 0.618 level in particular provides confidence that the trend is still intact, so buying from this level often sets the stage for the price to move back toward the peak. The 0.786 level has a different character. It is often called the last line of defense in the market. If the price reaches this level and fails to show a strong reaction, it may signal that the previous uptrend is weakening or has ended. Conversely, if the price reverses sharply from this level, it often signals the start of a very strong and fast rally. This happens because investors who have been patiently waiting until this level tend to enter with significant buying power. These strong buy orders shift the supply-demand balance toward demand, causing the price to rise rapidly. The importance of these two levels in technical analysis comes not only from historical price movements, but also from the structure of order books in the market. Many algorithmic trading bots place automatic orders based on Fibonacci levels. This causes volume to increase when prices reach these points, raising the likelihood of a reversal. In other words, when the price reaches the 0.618 or 0.786 area, an almost invisible wall of buy orders forms in the market. This wall prevents further downward movement and encourages the price to turn upward. These levels serve not only as horizontal support zones, but also as starting points for trend continuation patterns. In particular, reversals from the 0.618 level often lead the price to retest the previous peak. If the price breaks above the previous peak during this retest, it can gain much stronger momentum, sometimes even surpassing the prior upward wave. This is why investors view reversals from such levels not only as short-term opportunities, but also as medium and long-term profit potential. The fact that the price is currently close to both the 0.618 and 0.786 levels indicates that we are at a very critical stage technically. These two levels are generally not far apart, so the price may show a period of consolidation in this zone. This consolidation means the market is gathering strength before deciding its next direction. If buyers dominate in this area, it is highly likely that the price will move upward quickly and head toward new highs. Reversals from these regions are also often accompanied by increased trading volume. Higher volume serves as a strong confirmation signal that the reversal is healthy and sustainable. This is why it is important to evaluate both price and volume movements together. For all these reasons, the price is expected to reverse upward from the 0.618 and 0.786 Fibonacci levels. This reversal is supported not only by the logic of technical analysis, but also by investor psychology, market liquidity, and algorithmic trading dynamics. If this reversal occurs, it can bring both short-term rally opportunities and a continuation of the long-term trend. A price reaction from these levels that initiates a new upward wave also creates a positive market sentiment. This positive sentiment encourages more investors to enter the market, contributing to the price reaching higher levels. But we can't make a decision based solely on Fibonacci analysis. So let's look at other metrics as well. Stay tuned.
The current situation seen in the RSI indicator points to a highly critical level from a technical analysis perspective. RSI, or the Relative Strength Index, is one of the most popular indicators that measures market momentum and shows whether the price is in overbought or oversold territory. The price's current position corresponds to an area on the RSI chart that can be defined as a reaction zone. This zone is typically where investors have previously reacted with buying interest, meaning the price has found support here and shown an upward reversal. From a technical standpoint, the probability of an upward bounce increases in such reaction zones because the levels where buyers stepped in before tend to create the same psychological and technical effect again. Being in the RSI reaction zone suggests that the current selling pressure in the market may be starting to slow down and that buyers could regain strength. Looking at past price movements at these kinds of levels, similar conditions often led to upward reactions in price. When RSI falls below a certain level and then begins to show signs of recovery, investors often interpret it as an opportunity. This is because approaching oversold levels suggests the asset may be trading below its real value, which attracts buying interest. In this case, the likelihood of the price bouncing upward while RSI is in the reaction zone is quite strong. One of the psychological factors behind this is that investors often interpret such levels as a bottom signal. For example, if an asset has been in a prolonged downtrend, when its RSI reaches this area, many investors see it as an attractive entry point. At this point, as buyers step in, selling pressure decreases and the price begins to react upward. Especially large investors can make heavy purchases at such levels, shifting the market balance in their favor. The RSI being in the reaction zone also indicates that the price is technically close to support levels. This situation becomes even more significant when both the price chart and indicators generate the same signal. In other words, if price is at both a horizontal support level and in the RSI reaction zone, this combination boosts buyers' confidence. That in turn increases the short-term probability of upward movement. If a rise in trading volume is also observed at this stage, it is a strong sign that buying interest is robust and that the upward move may be sustainable. Additionally, if the RSI turns upward from this zone, momentum is seen shifting back to the positive side. Increased momentum drives price acceleration, which can quickly turn into a stronger uptrend. Moves starting from reaction zones aren't limited to short-term bounces. Under favorable market conditions, they can also set the stage for medium-term trend reversals. If the current downtrend is nearing its end when RSI enters the reaction zone, it may also be interpreted as a potential trend reversal signal. Furthermore, a bounce in price from the RSI reaction zone is important not just in terms of technical indicators, but also investor psychology. The perception that it won't fall much further encourages new buyers to enter. This can create a chain reaction that drives the price higher more quickly. Short-term traders in particular aim to buy in RSI reaction zones to profit quickly from price moves. As such buying increases, the price recovers faster, which can also draw medium-term investors into the position. In light of all this, the RSI being in the reaction zone makes the probability of a price bounce upward quite strong. Reviewing past recoveries from similar RSI levels shows that the price often responded positively from these areas. Of course, market conditions are not always the same, but when the signals from technical indicators align with investor behavior patterns at these levels, the probability of upward movement is high. If an upward breakout occurs from this zone and a clear RSI recovery is observed, this can lead to further acceleration in price and a move toward new resistance levels. In short, the RSI being in the reaction zone is a strong technical condition that increases the likelihood of a bounce from here. From both a technical analysis and investor behavior perspective, these levels are seen as potential buying zones, and historical examples show that such conditions often coincide with short-term positive price reactions. Therefore, the current position may carry an important opportunity signal for the market, making it a situation worth monitoring closely.
A large cup formation is considered one of the strongest and most long-term bullish signals in technical analysis. The formation of a cup pattern generally reflects a prolonged recovery process in the market. This formation appears when the price first experiences a long downtrend, then gradually recovers from a certain bottom level, approaching the peak level. During this process, the price essentially forms a U-shape or a deep bowl-like structure. The critical point here is that if the cup completes, the price may potentially have a significant room for upward movement. If the current price is close to completing the cup formation, this is usually an exciting development for market participants, because once the structure is complete, the measured target in technical analysis is the depth of the cup. If this translates to an extraordinary potential increase of around 580% when calculated in percentage terms, it creates a strong expectation for investors both psychologically and technically. For the cup formation to work, after forming the right side of the pattern, the price must clearly and strongly break above the resistance level at the peak area. Volume typically increases during the breakout because both short-term traders and long-waiting buyers enter the market at this point. A breakout supported by volume significantly increases the probability of the price reaching the target. The depth of the formation is measured to determine the target price. For example, the difference between the bottom and peak points of the cup is taken as the depth of the formation, and this difference is added to the breakout level to find the target price. The mathematical approach provided by technical analysis shows that if the cup is completed, a 580% increase is theoretically possible. Such a high percentage usually indicates that the formation has developed over a very long-term time frame, meaning both investor patience and market dynamics are very strong. Another important factor in these formations is market psychology. During the formation of the cup, most investors have either exited the market or do not believe in the possibility of a price recovery. However, as the price gradually rises and the formation becomes clearer, especially investors with technical analysis knowledge begin to notice the pattern. The formation of the right side and the approach to the peak area is like a countdown process. At this stage, the price may show short-term sideways movement or small corrections in the peak area, which can be seen as the market's preparation for the breakout. Once the resistance is broken, the phrase cup formation target begins circulating among investors, and this expectation positively fuels market psychology. Calculating such a massive 580% target naturally brings both opportunity and risk awareness to investors. Such a target means a significant return potential for long-term investors. However, it must be remembered that technical formations do not always deliver guaranteed results. Although the cup formation is a very strong signal, market conditions, macroeconomic developments, or sudden news events can negatively impact the process. Nevertheless, many successful examples in the past have shown that cup formations have a high success rate in reaching their targets. Especially when the price moves rapidly upward after the breakout, it marks the beginning of the process toward reaching the technical target. For this structure to work healthily, it's important that after the breakout, the price does not fall back below the breakout level. If the price experiences a pullback after the breakout, it's generally called a pullback and often presents an additional buying opportunity for investors. A return upward after a pullback gives a strong signal that the uptrend will continue. Reaching the formation target of a 580% increase can take time, as such large movements usually happen gradually. However, each new higher high and higher low formed on the way to the target confirms that the trend is progressing healthily. Cup formations are among the clearest structures reflecting the market's past declines and subsequent recovery process. For this reason, they're significant for investors both psychologically and technically. Especially a potential as extraordinary as 580% becomes a strong source of motivation in the market. During this process, investors need to be patient, avoid panic selling, and carefully follow technical levels. It should not be forgotten that the formation target is a theoretical level calculated through technical analysis, and reaching it requires supportive market conditions. In conclusion, the fact that the price is currently moving within a large cup formation and that the completion of this pattern could offer a 580% upside potential presents a very strong and exciting technical scenario. The completion of the cup, a breakout supported by strong volume, and a gradual rise toward the target can provide investors with a high long-term return opportunity. This structure, both by its nature and in terms of market psychology, may be a harbinger of a strong upward move. If market conditions progress in a supportive way, the probability of the formation reaching its target is quite high, and this 580% increase could go down in records as an unforgettable bullish story for investors.
Yes, friends. I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments. Analyze the risks correctly and always take strategic steps.
I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.